Hey everyone, and welcome back to another video for today. So we have a lot to discuss in this episode. We've had Shopify's earnings, Robinhood earnings, we have jobs data, and Bill Ackman about a new stock. He did tease that he was excited to buy a name that they've been following for quite a long time at a cheaper price, and today that name was revealed. Surprise, surprise, it is Meta. And so now he does own Alphabet, he does own Amazon, he does own Meta, and also Uber. You know me, I love all of these companies. So we're going to go over the reasoning behind that. We're of course going to go over everything else that you need to know. It's a crazy market. Okay, it's a crazy market out there. Good reports, good data get punished. Shopify was up 12%. Right now it's down 10% or something like that. So it is what it is. Anyways, if you enjoy this type of videos, hit all the buttons. We really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So this is the state of the market on Wednesday. As you can see, the usual suspects are red. Software names, tech names, they just keep on getting hit time and time again, no matter what. So if we look at our lists here, the name that's down the most, that's Robinhood, it's down 10%. If you look at Bitcoin, that is down 2.2%. To me, it's not rocket science. If Bitcoin continues to go down, in the short run, Robinhood will continue to go down. If Bitcoin goes up, Robinhood stock will go up. I will explain to you later why this doesn't make much sense. So this is basically what we're looking at right now. I do think that, as always, there are some deals in the market. Then if we look at the January jobs data, which were delayed because of the very short government shutdown. So non-farm payrolls came in at 130,000. The expected number was between 70 to 75,000. So quite a solid beat. Unemployment rate, 4.3%. Expected number was 4.4%. Labor force, over 387,000. So participation here is holding up. Unemployment, negative 141,000 to 7.36 million, which also means, by the way, that forget about your rate cut. There is no rate cut coming anytime soon. If we looked at the probabilities of a rate cut in March, it went from 20% to now, I think, 7% or so. Then where did the jobs come from? Healthcare and social assistance led the way. Construction added jobs, warm weather helped at the start of the year, and federal government and financial activities both lost jobs. As for revisions, November revised down 15,000 and December down 2,000. Of course, we always have revisions, so whatever the numbers were today, maybe they'll get revised down or up over time. We'll see. But this report, people were thinking, and we talked about it a bit yesterday during the live stream, we were thinking that the report would be very bad and the markets will crash. Guess what? Report was good, market didn't care. Moving on to Bill Ackman's choices here. So it was, I think, an 85 pages report. We'll just go over a couple of those. We have increased our exposure to high quality, higher growth mega caps. We believe these companies offer structurally higher growth than most companies in the S&P 500 at only modestly higher average multiples. And so they gave us here the examples: S&P 500 index, equal weight, next 12 months PE, 22 times and 18 times, medium-term EPS growth, 12 to 13 for the S&P index, and then 8 to 9% growth for the equal weight one. And then they compared it to Uber, Amazon, Alphabet, and Meta. So yes, you're paying here small premium, but if you're looking at the medium-term EPS growth, well, you are getting much more for that price. And so number one here is Uber. They've been bullish on Uber for quite a while. We are delighted to own Uber's above 30% EPS growth at only 21 times, while we believe the company disproves concerns around autonomous vehicles. I agree, I'm very bullish on Uber. I do think that this becomes the platform where you're going to see most, if not all, AVs on it. So Uber, high quality business positioned for continued rapid earning growth, trading at a compelling valuation on misplaced industry concerns. They basically name here all of the metrics that we already looked at when we went over the recent earnings report and earnings call. Medium-term outlook positions Uber for continued teen plus bookings growth and over 30% growth in earnings per share. Uber targeting commercial AV operations in over 10 cities by the end of 2026. Uber and Waymo driving best-in-class asset utilization. Future expansion is likely. I think once we get such a headline, the stock will start to go back up. Based on the current numbers that we've got from Uber and the expectations for 26 and onwards, I do believe Uber is extremely undervalued and actually added more shares today. Moving on to Amazon, which is also one of those disrespected names in the market for some strange reason. Now, Amazon, as you can see, it was never a cheap stock, especially not if you look at PE, because, well, sometimes earnings were non-existent for this type of company. This is a company that if it makes money, it just reinvests everything to make sure that the company becomes better and better and better. But right now it seems like this company can invest quite a lot in the business and still be profitable. We've talked a little bit about it yesterday. AWS growth, there are some analysts that are expecting AWS growth rates to be above 30%, especially the exit rate of 2026. So if that happens, I do believe this is a $300 stock in the making. We're now at around $200 per share, which doesn't really make that much sense. We are seeing already today AWS growth accelerating. Would be very surprised if we don't see mid 20% growth for the next 2 quarters. Would be great if we even see more than that. And then the rest, advertising, subscriptions, all of that high margin business continues to grow. And as you know, with Amazon, the total addressable market for that company has expanded over the last 2 decades. This leads me to a company that was extremely undervalued last year, and that's of course Alphabet, Google. And the reasoning behind this is not new to us. We've talked a lot about this company in 2025 when everyone was hating it, when analysts came on TV and talked about the fact that search is going to die and talked about the fact that, oh, blue links, the 10 blue links were still a thing. Yes, Brad, I'm talking about you. It didn't make any sense to me. It didn't make any sense to you either. We looked at the cloud growth. We looked at search strength. We looked at AI overviews, AI mode, all of that. Everything led to, well, this is a very, very cheap business. We bought quite a lot of it in 25, and right now we are quite happy that we did. Moving on to Meta. So they said here, we believe concerns around Meta's AI-related spending initiatives are underestimating the company's long-term upside potential from AI, showing us here the multiples. Meta is now the cheapest big tech name out there. $200 billion in revenue, growing above 20%. I mean, come on. Well, we've seen worse businesses trade at a much higher multiple. So they talk about this right here, family of apps. Yes, Reality Lab is still a money-burning business. Will it ever become profitable? Remains to be seen. But the core business is just so profitable today that it allows them to take these types of risks. Of course, the big question around Meta is, can it continue? Can they continue to take these types of risk and still see the return on investment that we've seen from the company or return on invested capital over the last 5 to 10 years or so? I believe we will. And so they said the following thing: high quality advertising business model with increasing returns to scale. Meta's business model is one of the clearest beneficiaries of AI integration. Why is that? AI leverages Meta's rich first-party data to deliver more relevant and personalized ads. Campaign automation and AI copy creation tools facilitate self-serve model for advertisers, and there is a potential to unlock new use cases and engagement modes, business AI digital assistants, wearables, etc. It also increases the content creation, which means more time spent on the apps, which means more ads get served, higher return on investment, more money spent, more revenue for Meta. They're well positioned for long-term earnings growth after planned spending ramp in 2026, and strong balance sheet and high margin core business provide significant financial flexibility. Remember, at one point, all of these companies will not increase capex that much anymore. And when that happens, well, again, you are going to see what we've seen in 2023 after 2022 margins went down. Margins are going to expand, stock is going to soar, and you are going to say, I should have bought it when nobody wanted to buy it. And so I'm not surprised by these moves. I'm not surprised at all. I actually think it's a good move that they pivoted from restaurant business, hotels, things like that, to companies like Uber, Amazon, Alphabet, and Meta. As you can clearly see here, next 12 months PE, even trailing PE, because next 12 months can always change. It is not expensive for the growth that you're getting. And if you think you can vibe code an Uber or an Amazon or an Alphabet or a Meta, then I've got a couple of bridges and couches to sell you. Which leads me to Shopify. Shopify is down 8.5, 10% or so right now. Like I said, at the start of the day, this thing was up 12 to 13%. Now Shopify, as you can clearly see, has also experienced a drawdown here of around 35% so far. Of course, all of this is powered by fiscal.ai. There's a link down in the description. And in the pinned comment, you'll get 15% off if you use my link. And you can also try Fiscal Pro for free for the first 2 weeks. And so Shopify is another one of those companies that is a victim of this whole, oh, AI is going to destroy software names. You can vibe code this, you can vibe code that. Sorry to say, but I don't think you will be able to vibe code a Shopify copycat. Now, that said, if we do look here at some pricing metrics, this is definitely not a cheap name to own. This is, yes, now a less expensive company, but it is an amazing company. So you tell me, if you look at this right here, merchant first focused through product innovation, all of this is what Shopify offers to you. Do you think you will be able to create this type of solution on your own? Do you think anyone will be able to create something like this just because, oh, I'm a vibe coder? No. And even if you think you've created something that is useful, do you have the users? Do you have the capacity to keep everything in place? Do you have the capacity to update everything, maintain all of these systems, the servers, customer support, all of that? No, the answer is clearly no. I'll have a specific software episode probably coming out tomorrow or so. We're going to go over a lot of software companies, see if it makes sense, see if it doesn't. But this whole I can vibe code a company to the ground story that we're seeing right now, to me doesn't make much sense. Going back here to Shopify, last quarter, they grew 30.5% year over year. And of course, the majority of the revenue comes from merchant solutions. If you look at GMV growth and GPV growth, that is still growing above 30% year over year. And remember, these are growth rates that have increased, yet the dollar amount has also increased quite a lot. So always a good thing to know. Then, if we go and look here at a couple of things that they mentioned during the earnings call, they are now powering 14% of US e-commerce market share. Q1 2026 revenue growth is expected in the low 30s, similar to Q4, but we know that Q4 is a very, very strong quarter because of the holidays. Now, gross profit is expected to grow at high 20%, slower than revenue growth. Operating expense as a percent of revenue is expected to be at 37 to 38% versus 29% in Q4. Q1 free cash flow margin is expected in the low to mid-teens versus 19% in Q4. So you can already start to understand, okay, why the market is now a little bit skeptical, because maybe growth rates are going to slow down. Q1 is already a seasonally weaker quarter because it's the one after the holiday season. But when you look at those numbers right here, it's still a company that's expected to grow quite rapidly. Then orders from AI search up 15x since, well, a year ago, but of course a very, very small base. Remains to be seen how fast this can continue to grow and how big of an impact it has on revenue and profits. Business to business GMV up 96% in 2025. International revenue is up 36% and offline is up 27%. And the board has authorized $2 billion in share buybacks, which means you should like the fact that the stock is coming down right now, because that makes more sense when you want to buy back more shares. Same with Robinhood. And so if we look at Shopify stock right now, we can see that it's literally touched the same point of the bottom of last week. This is on the weekly 100-day moving average. If we look at the daily right now, we are a bit in no man's land, but it did also bottom or touch that bottom from last week. Is it the true bottom? Is it not? I don't know. But last week we were very much oversold. Looking at Hood on the daily here, also in no man's land, pretty close to the bottom of last week. We are slightly oversold. Last week we were, like many stocks out there, very much oversold. If you look at the weekly for Robinhood, and don't worry, we're going to go look at the numbers in a bit. At the weekly, it's between the 50 and the 100-day moving average. RSI is pretty low, but like I said, if you look at the chart, it topped here at the start of October. Then if we go and look at crypto, same thing here. Peaked at the start of October, is the exact same pattern. And so if we look at Hood right now, stock is still up 44% over the past 12 months. Market cap wise, we're not a $100 billion company anymore, a bit smaller than that. Of course, when the stock gets slashed in half, this is what happens. What also happens is that valuation makes a lot more sense today than it did before. Now you might say, yeah, but it's a highly cyclical business. Now, if you told me this 2.5 years ago, I would 100% agree. Today, I agree, but I disagree way more. Because if we look at how they generate revenue, yes, a big chunk of it does come from net interest revenue, which is good because it seems like rates are going to stay higher for longer. So this part right here continues to grow. Then what do we have? The blue part right here, which is crypto revenue. As you know, if there is a crypto winter, then yes, you should expect that revenue part to become smaller and smaller, which will impact the company negatively. Then options is also a big part of the revenue. What is becoming a bigger part of the revenue is this purple bar right here. That's the other transaction-based revenue. Most of that comes from the prediction markets. What is interesting here is that the reliance on crypto revenue becomes smaller. This quarter, 17.2% of overall revenue was crypto. Last quarter was 21%. So even last quarter, where things were fine, people overreact. Only 21% of the revenue comes from crypto. Now 17.2. Now you're going to say, yeah, but that's because crypto revenue went down. Yes, also. But if you look at quarter over quarter, revenue was basically flat, which means other parts of the business are growing much faster than crypto is decreasing. Which part is that? This one right here. The other transaction-based revenue, which are prediction markets, went from 5.6% to 11.4%. Options here stayed the same. And this will continue, and that's a good thing. Yes, I understand people don't like prediction markets. I get it. Don't use it. I also think that Robinhood should give you the option, especially if you're a new user, give you the option, are you interested in prediction markets, yes or no? If you say no, prediction markets should not pop up on your screen. Now, this is what is happening right now. Look at this huge increase right here. I'm fully expecting this to continue to go up and to the right. We'll look at specific numbers in a bit. Net deposits, funded accounts, net deposits, $15.9 billion for the quarter. Funded accounts here sits at 27 million, continues to grow. Yes, it's true that the quarter that they just reported is not the best one out there. That's also the reason why the stock got cut in half. So makes sense. If you look at the expected growth for this year, 23.7% year-over-year growth in revenue, then just 15 in 27, and then an acceleration to 21.3%. I think it's very, very difficult to project these types of numbers because it really depends right now on what the market is going to do. Then they showed us their market share gains in equities, 1.11%, options up 70% to 7.5%, crypto 1.24%, that's up 130% year over year, and margin sits at 1.12%, that's up 81% year over year. They're growing very, very fast, but this is still very small compared to the total addressable market. Looking at less cyclical stuff, net interest revenues, that was up 39% year over year to $411 million. If we look at the interest earning assets, that increased 39% year over year to $62 billion. Now in Q3, that was a little bit higher, but I'm expecting this to continue to grow for the full year, right? If you look at this on an annualized basis, this continues to be a big part of the overall revenue. And then just look at this. Event contracts traded in billions of contracts, that's up 3x, over 3x, quarter over quarter. New products are very, very successful on Robinhood. And that's the thing. If people didn't like these things, you wouldn't see these results. There's a lot of noise out there. And again, I understand people might not like it. I said it before and I'll say it again. I don't think you should have betting or prediction markets in the same page as your investments. Moving on to what they said during the call. Prediction markets reached $300 million plus run rate in the first year. That's the fastest growing business in Robinhood history. Over $4 billion in event contracts traded so far in 2026. We know that January was 3.4 billion, which means over 600 million is already in February, and we're just at the start of the month. Roterra, their joint venture with Susquehanna, is targeting mid-2026 launch, which means they could grab more of the pie of the prediction markets fee, because currently that's a 50-50 split with Kalshi. They plan to more than double Gold Card users to over 1 million by the end of 2026. Why is that important? Because Gold Card reached $10 billion in annualized spend with 5x growth in 2025. Indonesia acquisitions expected to close in the first half of 2026. They're expecting to grow, of course, internationally, and they have 11 businesses with over $100 million in annualized revenue, and they're expecting to add a couple of extra this year. This is a business that, yes, previously was very, very cyclical, but they are diversifying quite a lot. I've also added more shares of Robinhood today. I did also add a little bit more yesterday before they reported their quarterly figures. Yes, the stock is down 10% right now, but I'm building up that position. I do still think that over the long run, Robinhood is going to be a huge company. You're always going to have haters out there, but they're definitely doing something right. Otherwise, it wouldn't be a huge success. All in all, the market right now is extremely strange, very volatile as well. Things don't make a lot of sense. I don't know how long this will take, but take the opportunity to look at good companies. There are definitely quite a lot of good deals in the market out there. That's about it for me in this video. Let me know what you think about it down in the comment section below, and we'll see each other in the next one. Bye-bye.